Our fund is a long-short Australian equity fund, also known as an absolute return fund. There's a negative perception around the term hedge funds in the Australian marketplace. The reality, though, has been quite different. Due to the flexibility of investment mandates of most hedge funds and their ability to hedge their overall market risk, most well-managed hedge funds have outperformed underlying asset classes in recent times and have delivered those returns with lower risk. Now, the underlying asset class of our fund is Australian equities, and therefore we're looking to protect our assets in a falling equity market environment. And we can do that through hedging our exposures. We can short sell equities, those that we think will fall in value, and make money from that. Alternatively, we can use derivatives to hedge our overall market risk. We've got a number of rules around measuring risk with our portfolio, starting off at the portfolio level, where we have rules around our exposure, both our gross and net market exposures. Importantly, we do not use financial leverage. At the individual stock level, we use stop losses to try to cut our losses early. And finally, we do use derivatives also to hedge our overall risk, and we use those derivatives both at the individual stock level as well as at the overall portfolio level. We do have very strong guidelines around our risk, and we need to adhere to those, particularly in this volatile market environment. As an example, we use share price index futures contracts from time to time to protect the overall portfolio from falls in the market. The global financial crisis was a great test of the capital preservation capabilities of managers, and a number of managers got into difficulty through that period by using financial leverage. Now, financial leverage works well in a rising asset class environment, but when asset values are falling, it has the opposite effect. Our fund in 2008 had a small positive return, whilst the underlying asset class Australian equity market fell over 40%. Firstly, our fund's interesting in that it is a mix of both capital preservation and growth. So in a strong market environment, we will be attempting to keep up with the market and capture as much of the gains as possible without having all of the capital at risk. But equally importantly, in a negative market environment, we go into capital preservation mode and try to protect the capital until the markets recover again. Secondly, our return has had a relatively low correlation with the underlying Australian equity market. So in a portfolio context, it reduces the overall volatility of returns and smooths out the return profile. Finally, we're in a lower return environment as the world deleverages, and in that sort of scenario, you need to have active management of your portfolio.